Hello students, today we are going to start with the second session of auditing. Before that, let us have a small review of our previous class. So in previous class we studied auditing, word meaning, auditing definition given by ICAI and the different functions of auditing. And you have given an assignment to collect at least one auditor's name. So I hope all of you have did this assignment and share with your friends so that um, you comes to know a lot of auditors' name and the company. So let us start with the objectives of auditing. So these objectives represents the goals of auditing function. So for what purpose we are doing auditing? So these objectives are broadly classified into three, that is primary objectives, secondary objectives and specific objectives. And these secondary objectives are again classified into two, that is detection and prevention of errors and frauds. And these errors also classified into various forms: clerical error, errors of principle, compensating errors and errors of duplication. And this clerical error again divided into errors of omission and errors of commission. And these frauds are classified into again four categories, that is embezzlement of cash, misappropriation of goods, manipulation of accounts, and window dressing. Apart from these two objectives, so we have one more objective, that is specific objectives for auditing. Let's see one by one. The first one, primary objective. So as the name indicates, it represents the most important. It is the fundamental objective for our auditing. The auditing and assurance standards of the Institute of Chartered Accountants of India. So this Chartered Accountants of India have a separate wing to decide the standards for auditing. As we have the standards for accounting, we have separate standards even for auditing. How to audit the specific fund. And they are going to fix some standards for each auditing. So this is that the primary objective is to express an opinion on financial statement. To express an opinion on financial statement is the basic objective of auditing. So based on his scrutiny or his verification of books of account, auditor express his expert opinion about the trueness and fairness representing operating results and the financial position of the enterprise as disclosed in the financial statement. So giving opinion on financial statement is a basic function or basic objective of auditing, and this objective or this opinion will be based on his verification of books of accounts, and in his opinion he is going to state that whether the financial statement prepared by the company represents trueness as well as fairness. So it is the basic function or the primary objective of auditing. And the secondary objectives. So as the name indicates, it's not the primary, it's a secondary. So here these objectives are going to support the primary objective. And these objectives can be classified into two categories, that is detection and prevention of errors and detection and prevention of frauds. So detection, that is finding out. So finding out after the things happen. But prevention means so finding the things even those things occurred in our company. So detection and prevention, we have two sets of things. Detection, so finding the things after the incidents, or prevention, so finding the things before it happens. So detection and prevention of errors and frauds. So let us see the first one, detection and prevention of errors. So here we should know the meaning of term errors. Errors are unintentional mistakes. So errors represents mistake which is unintentional. So here unintentional means they should not have any such objective to deceive or to cheat someone else. So if the persons having no intention of deceiving someone or to cheat someone, if we did some mistakes, so those mistakes are considered as errors. So there is a slight difference between errors and frauds. So errors are unintentional mistakes, but the frauds are intentional mistakes. So these errors can be classified into four. There is clerical error, errors of principle, compensating errors, and errors of duplication. So let us take the first one, clerical error. So as the name indicates, mistakes committed by the clerks in the company. The mistakes committed by the people in the accounts department responsible for the preparation of accounts. While preparing books of accounts, if the clerks of the accounting department did some mistake, and those mistakes or errors are called as clerical error. So committed either in recording the original entry or in the calculation process in or while posting from the journal to ledger or ledger to a trial balance or in the totaling of different ledger account or while balancing. So if they committed some mistakes and those mistakes are unintentional, in such situation it can be called as clerical error. So there are two categories of clerical error, errors of omission and errors of commission. The errors of omission indicates a transaction has not been recorded in the books of accounts either completely or partially. So we forgot to record some transactions. In such situation, it's called as errors of omission. So here, take an example. Actual transaction is sales of rupees 1 lakh to Miss Ramya. What they are recorded is they are not recorded anything regarding this sale. In that situation, errors of omission completely because they forgot to record the entire transaction. So it is errors of omission. See the second one, credited sales account but not debited Ramya's account. So for this sales transaction, the entry is Ramya's account debits to sales account. They have recorded the sales here, but they are not debited to Ramya's account. So for that reason, so it is partial omission. They have recorded one aspect but forgot to record another. So it is partial errors of omission. Errors of omission is forgetting to record some transactions in the books of accounts. So there are two categories, complete and partial. In case of complete errors of omission, they completely uh, forgot to record the entire transaction. They omit to record the entire transaction. But in case of partial omitting, they record only partial entries, but they will leave another part of entry. Errors of commission, the opposite to errors of omission. Here they record the transaction but in a wrong way. So here mistake consisting of doing something wrong, such as recording entry twice, recording wrong entry, recording in a wrong place, or wrong calculations. So here recording the transaction but in a wrong way. So this wrong way may be either in the form of entering twice or recording wrong amount, recording in a wrong place or wrong calculation. So let us take an example. Transaction is purchase of rupees 1 lakh from Miss Shubha. So we have purchased 1 lakh worth goods from Shubha. Recorded twice. So I have recorded this transaction twice. So For purchase, so we have to record purchases account debit to Shubha's account 1 lakh rupees. But I have recorded twice. The same entry recorded twice. The purchase account shows 2 lakh and Shubha's account shows 2 lakh. And the second error may be like this: recorded purchases account 10,000. We have recorded the entries. The purchase account debits 10,000 to Shubha's account 10,000. But the original amount was for rupees 1 lakh. Recorded wrong amount. So these kinds of errors are considered as errors of commission. We have recorded the entry, we have not forgotten, but in a wrong way we have recorded it. So these two are errors of omission and errors of commission are the examples of clerical error. And the second category of error is errors of principle. So here principle representing principles of accountancy. So accounting mistake in which an entry is made in the wrong account. It might be in the wrong account or violating the fundamental principles of accountancy. Errors of principle indicates the errors which violate the principles of accountancy. Consider an example. The transaction is cash purchase of machinery. So for cash purchase, you know that the correct entry is machinery account debits to cash account. So machinery account is a real account. What comes in? Machinery comes in. So it is debit machinery account. Again cash account. What goes out? Credit. So it is cash account. But they have recorded, instead of this entry recorded, purchase account debits to cash account. They have purchased machinery, so they wrongly assumed that it should be debited to purchase account. So if it is a revenue item like goods, we have to record like this. If it is goods, so we should consider it as a revenue item, and in that case it will be purchase account debits to cash account. But it's a capital item, so we have to debit machinery account. So if they have recorded like this, which will violate the fundamental principles of accountancy. So in such situation, we are going to call these categories of errors as errors of principle. They are considered revenue item, capital item as revenue item. Compensating errors. So an error in calculation compensated by an opposite error. So here there are double error. In order to compensate our earlier error, we will commit another error. So there are double errors now. Original error and compensating error. They do not affect the total and difficult to locate. So the two errors are balanced so that net effect will be 0. So for that reason, it will not show any imbalance either in the trial balance or in the ledger. So for that reason, it's very difficult to locate. It's not one-sided error, it will be two-sided now. Consider an example, wages paid rupees 10,000, but they have recorded wages rupees 8,000. So there is a difference of 2,000. They have undervalued the wages of rupees 2,000. Under recorded wages 2,000. So in order to compensate this mistake, they have committed another mistake, that is compensating mistake, increased salary by rupees 2,000. So here original transaction of was wages paid 10,000. Instead of 10,000, by mistake they have recorded wages 8,000. So here's under recording of wages by rupees 2,000. So they shown the expenses lower amount of 2,000. So in order to adjust this under recording, they will increase the salary by rupees 1000. So the net effect will be the same because total expenses will become 10,000. So instead of wages, they have shown it in salary. But there are two mistakes now. The first mistake is in the form of under recording of wages, and the second mistake with the salary, that over recording of salary by rupees 2000. So these kind of errors are considered as compensating errors. And the last one, errors of duplication. So as the name indicates, duplication means recording twice. If any entry made in the original books recorded twice and posted once. Sales of rupees 10,000, journal entry recorded twice, and these journal entries are posted to ledger account twice. So in any company, it is the duty of auditor regarding prevention of errors. He has to prevent these kind of errors. For this, there are some tips to the auditor to avoid these kind of errors. The first one, check all the original entries with the vouchers. He has to verify the original journal entries with the vouchers. For example, if they have recorded sales of rupees 1 crore, so he has to verify this sales with the supporting document. So verification with the supporting document is considered as vouchers. So vouchers indicate the supporting document. For this sales, what is a supporting document and whether this entry is true or not. So he has to verify. And the second one, sales. So see whether posted to proper side of proper ledger account or not. He has to verify whether this sales is recorded in the sales ledger. And again in the proper side, whether it should be in the debit or it should be in the credit. So these things that he should verify. Check the entries posted from the ledger to the trial balance. So from journal entries, the first one in the journal entries, and the second one posting journal to ledger, and the third one posting ledger to trial balance, because there is a large possibilities of mistakes from ledger accounts to trial balance or journal accounts to ledger accounts. So in the process of posting, so there is a huge possibility of committing mistake. Check the total of trial balance and the ledger accounts so that it will be easily find out the mistake. Total the list of debtors and list of creditors along with the debtors and ledger creditors ledgers account. Compare the trial balance items with the previous one. So it is the most important thing. So even though he is auditing 2020 financial statement, he has to verify or he has to compare 2020 items with the 2019 items. For example, debtors in 2020 is 2 crore and debtors in 2019 is 10,000. So there is a huge gap in between these two things. So from 20,000 to 2 crore means, so there is a huge gap. So that this gap indicates or signals some mistakes in the books. And careful verification is the final tool with the auditor for all the things. They should be very careful in his work. So, in today's class, we have learnt primary objective, that is to express his opinion regarding the genuineness of financial statement. And in the secondary objective, there are two categories, detection and prevention of errors and frauds. So in today's class, we have completed detection and prevention of errors. So in errors, there are four categories: clerical error, error of principle, compensating errors, and errors of duplication. And again in clerical error, we have two categories, that is errors of omission and errors of commission. So in the next class, we are going to start with detection and prevention of fraud. So before winding up today's class, so here's a small assignment to you. Write at least one example for all types of errors. For each categories of errors, write one example so that you will be very clear uh, regarding these categories of errors. Hope you understood the pleasant class. Thank you for watching. Take care and happy learning.